What's up guys, in today's video we're going to be discussing this news article, this headline which says sell in May and go away amidst inflation risk, which we're certainly facing as of right now. Now this is without doubt pretty serious stuff and certainly goes beyond a little bit of a catchy headline. So the question is now the right time to actually look to sell our shares and sit this one out for the next few months ahead? Well, in this video we'll talk about all of the details of cyclical market behavior, as well as we'll dive into this article in a little bit more detail and talk about some of the inflation risks in which we're certainly going to be facing as investors throughout the course of this year. But before I do so guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys, really helps out the channel. And with that being said, let's dive straight into it. So firstly, let's talk about where the verbiage sell in May and go away actually comes from. Well, I did a little bit of Googling and I stumbled across an article over on Investopedia which simply says that it's based on historical underperformance of some stocks during the summary 6-month period commencing in May and ending in October, compared to that of the wintry 6-month period, or i.e. the back end of the year as well as Q1 as well, from November to April. If an investor follows this strategy, they would divest their equity holdings in May or at least late spring and then invest again during November or the mid-autumn. Now this is actually an old English saying whereby back in the day, or well before my day anyway, where aristocrats, merchants and bankers would actually leave the city of London and escape to the countryside during the hot summer months. And then all of these individuals would then return back to the city in mid-September, ready for the Triple Crown event, which is in essence a horse racing event over here in the UK. Now based on those studies in which have been completed on the topic, since 1950 the Dow Jones Industrial Average has had an average rate of return of only 0.3% during the months of May through to October, compared to that of an average of 7.5% during the months of November through to April. Due to this, you can make the likely assumption that your stock portfolio is likely going to trade flat, or if not even a little bit in the negative during the summary months, whereas in the latter part of the year as well as into Q1, you could expect far more when it comes to a return on investment. However, having said that, those studies perhaps aren't as accurate as they once were, because over the course of the past 10 years worth of stock market performance, if we look through the periods of May through to October, only 2 out of those 10 years actually provided negative return on investment. So based on those numbers, you would be better off 80% of the time over the course of the past 10 years, of course, to actually keep your money invested into the stock market. And to be honest guys, that's certainly the approach that I will continue to take, because I'm a strong believer of time in the market versus timing the market. So due to this, I will certainly look to continue my cost averaging approach, my cost averaging strategy, and I will continue to invest into the stock market regardless of the conditions in which we're faced with. But the question is, could things be slightly different this year? Because the reality is we haven't actually seen any kind of prolonged sell-offs in the stock market for about 10 to 13 years, basically since the financial crisis of 2007 and 2008. Now yes, we did see a sell-off in the stock market during March last year, but we saw such a quick recovery which was almost artificial in its nature, and because of that we haven't actually seen the stock market tested over a prolonged period of time. So let's build on that somewhat and talk about the reasons why things could be slightly different this year, and that the old verbiage kind of sell in May and go away could certainly hold true. And the big reason for that, one of the biggest concerns on most investors' minds right now, is something called inflation. Now inflation is a really boring economic term to talk about, but if you've got any aspirations of being a long-term investor, these are some of the key terms in which you're certainly going to want to know about. So for those of you guys who don't know, inflation is simply the increase in prices of a basket of goods, which therefore means prices increase gradually over time, and therefore your Great British Pounds or United States dollars or whatever currency in which you use essentially becomes less valuable over time because your purchasing power decreases. As an example, over here in the UK, back in 2005, when I was about 10 years old, the price of a Freddo bar was 10 pence. However, as of 2021, the cost of that same Freddo bar is 25 pence. So that is a 150% increase in the price of a Freddo bar in the past 16 years, which is roughly a 10.6% increase on prices every single year over the course of that period. But what on earth does the price of a Freddo bar actually have to do with investing into the stock market? Well, it's not so much the gradual increase in inflation that's actually a bad thing. In actual fact, it's a pretty good thing to have a healthy amount of inflation over time. However, where the real risk and where the real issue lies is where we have sudden and rapid increases in prices and a big increase in inflation in a short period of time. The rationale behind this, with prices moving higher like we've seen across commodity markets as well as even the housing market too, it means that consumers start to purchase less, and with consumers purchasing less, it means that companies fundamentally start to make less revenue and therefore profit. And with profits slowly declining over time, it means that the economy therefore slows for a period of time until a measure of economic equilibrium is reached. Well, a pretty good place to start here is actually the UK housing market, whereby we've seen the fastest rate of growth since 2014, with the Office of National Statistics reporting the average UK house price rising by 8.6% year over year to February of 2021. Now, to kind of put some numbers behind that, the average price for a house in the UK is now up to £250,000. And that's certainly great if you're already a homeowner, because you will have managed to gain 8.6% over the course of the past 12 months, which is circa about £20,000. So whilst all the homeowners out there have bagged £20,000 in equity, it's then also become £20,000 more expensive for all of the first time buyers to actually get on the property ladder. And the same certainly goes for commodity prices across the energy markets. We've got crude oil up 34% year to date, natural gas up 15.75%, we've got gasoline up 51.4%. Even when we look across to agricultural markets, we've got soybeans up 20.4% year to date. We've got the price of wheat up 14.4%. Cheese is up 3.5%, milk up 11.6%, rice up 9.64%, and even livestock is getting more expensive, with beef, the price of beef being up 12.4% year to date, and poultry up 11.65%. So if you start to see your energy bills or even your weekly shop becoming ever more expensive, now you know why. But what makes all of this a problem for the stock market? Well, I don't know about you guys, but I certainly haven't received a 10, 20 or 30% increase in my annual salary this year. So because of that, things have become certainly comparably more expensive than they were this time last year. Due to this, not only are our Great British pounds becoming less valuable year in, year out, especially with these such high levels of inflation, but it also means that we're likely going to be stopping spending our money elsewhere. So whilst you certainly might be spending a little bit more down in Asda or Sainsbury's, you might then also make decisions not to go and buy the latest iPhone or even go and buy a brand new car. Because sure, sharp rises in inflation can certainly affect consumer spending habits. And driven by the fact that we're certainly not home and dry from this pandemic just yet, and the fact that there will certainly be a prolonged period of job losses as a result of it, this could certainly mean that we see less revenue being generated by companies and therefore less profit. And with a positive correlation between a company's earnings per share and that of their stock price, well, if earnings start to fall, then you can only expect that their stock price will follow too. Now, one thing that could exacerbate this whole inflation problem in which we have, and certainly the risk in which we're facing within the stock market currently, is if we see either an increase in interest rates or an increase in capital gains tax, which funnily enough, Joe Biden has recently come out of his economic plans, which suggest that we could see a proposed higher rate tax band over in the United States. This isn't for us guys over here in the UK, but over in the United States, taxing the wealthiest of investors somewhere in the realms of 40% in capital gains tax. Now, the problem with this isn't so much the physical amount in tax that these wealthy individuals will have to pay. In actual fact, it's the actions that they go on to take as a result of having to pay more tax. A couple of examples of this is that they could naturally decide to invest less in the stock market moving forwards, or even indeed look to sell a bunch of their investments before this capital gains increase comes into play. Or perhaps on the other hand, they invest less back into the business or businesses in which they've built, which could therefore have a prolonged effect on economic prosperity and kind of unemployment rates on the whole. All of this could therefore have an overall adverse effect on the economic prosperity of a country, and therefore the ability of individuals like me and you to actually be able to invest into the stock market. Now, with both the US as well as European markets starting May off with a sea of red across the board, and with the volatility index up over 10%, whilst I'm certainly not sure about the complete outcomes of this inflation risk in which we're certainly seeing, we could certainly well be in for a few rocky months ahead in the stock market. I think it's an important point to make here that you should try and plan for all eventualities in which you could certainly face, which may mean having a little bit of cash flexibility and having some cash buffers in place as well as making sure that you're also not too overexposed to the stock market. The key to investing is balance, so make sure that you try and seek this out in whatever way in which you feel is most appropriate. So with that said, guys, be sure to let me know your thoughts on the current state of the stock market, as well as the current state of the economic conditions in which we find ourselves in. And if you did enjoy the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.